There's an incredibly simple strategy that's been beating Wall Street for the last 56 years. If you just buy the top 10 stocks by market cap, it's crushed the S&P 500 by over 3x during that period. But the reason it works is what matters, because when you see the data behind it, it completely changes how you should be thinking about building portfolios, and especially a crypto portfolio. And most people are doing it completely wrong. This video is for information and entertainment only. It reflects my personal opinions and is not financial advice. Check the description for more information. Always do your own research. So the S&P 500, the US stock market, basically, is an index fund that tracks the top 500 companies in the US. Every quarter, if a company was in the top 500 and is now no longer there, it's removed, and the company that came in and took its place is added in. So it's rebalanced quarterly, and it's market cap weighted, which means the larger companies, like Nvidia, right now, take up a much larger portion of the index than the smaller companies. And this index is the benchmark for how hedge funds, how Wall Street tracks their progress. If you're not beating the market, then what's even the point? You might as well just be in the market, buy the index fund. Now, one strategy has been incredibly successful, very, very simply, at beating the S&P over the last 56 years. And it might surprise you to learn what that strategy is. Very simply, that strategy is just taking a more concentrated bet on the index. As we said, the index is market cap weighted, so the larger companies take up a bigger share of that market. If you just get rid of the other companies and you just focus on the top 10, over the course of 56 years, the power of compounding means those returns are 3.27x greater. Now, while I was conducting the research for this, I compared the S&P 1 against the S&P 3, against the S&P 5, against the S&P 10, so on and so forth. And what you find is that just holding the largest company in the US and then rebalancing every month someone else comes and takes the throne isn't as good as just holding the index. But when you start taking concentrated bets, which have a little bit of diversity built into them because they've got more companies, they actually begin to start beating the index. And this is surprising because most of the time people are very concerned about concentration risk. But because these indexes are market cap weighted anyway, there's concentration built into the entire index in the first place. And what you can see from this here is that the S&P 10 returns 12.68% compounded annually, which over time produces enormously better results than the S&P 500. Now, why does this work? Well, 𝗙𝗃𝗏 studied every US stock since 1926, which was 26,000 stocks over basically 100 years. And what he found is that 54% of stocks over the course of their life lose money. So only 4% of stocks explain the entire wealth creation of the market. And said another way, collectively, 96% of stocks do not beat treasury bills. So 96% of all the companies that are listed in the US, the public companies that can be tradable, they don't beat treasury bills. And this stat top is completely mental. 90 stocks, you think Amazon, Apple, Nvidia, created 50% of all stock market wealth. I mean, that is mind-blowing. The concentration in the winners is wild. And so it makes sense to think that what's important is holding on to a unicorn like Nvidia or Amazon when they're small and riding them all the way up. And yes, of course, that is vital to the stock market's returns generally. 33% of the entire S&P 500 returns were attributable to Nvidia in 2024. In 2020, 23% of that was attributable just to Apple. And the last couple of years, we've seen enormous concentration inside the Mag 7, not surprising. In 2023, 84% of the index's returns were attributable to the Mag 7, and in 2024, it was still 55%. So without the Mag 7, the S&P would have produced negative returns in 2023. And this shows you this research live, playing out in real time. And this has got people, of course, concerned that the concentration in amongst the very few winners is a problem. But the truth of the matter is that concentration across global stock markets is very normal, and actually sometimes it goes much, much higher. On average, The top 10 contribute to 48% of the entire market in that country. And so the US actually comes underneath that. Right now it's about 40%. It changes all the time because NVIDIA just passed $5 trillion in market cap, always changing. But, you know, it's not actually that bad relative to the rest of the world. And this is how the rest of the world stacks up, right? France has got enormous concentration. The Nikkei's got pretty big concentration. Global average is, 48%. The FTSE's 46. The S&P is relatively low underneath all those in terms of its concentration. And everyone panics about US markets being incredibly concentrated, but they're actually beneath the global average, which is kind of crazy. In Finland, Nokia, obviously the mobile phone company, at one point made up 70% of that entire stock market. There's been incredibly dense concentration across global stock markets throughout history. And when this has been studied, high levels of concentration have a statistically insignificant association with future returns. Vis-a-vis, stock market concentration doesn't predict for bad performance in the future, which is contrary to what we want to believe as individuals. It goes against our idea of you should be buying low and selling high. It just doesn't, those two things don't compute. This actually says you should buy high and sell higher. One thing that is worth considering at the moment in the US stock market is that actually its concentration is greater than it has been in the past in the US. If you just check this little bit out here, look, 40% is actually quite high for the US, so maybe there's some signal in that. But globally, that concentration hasn't actually played out to be a problem. Not to say it can't in the future in the US, but, if history is anything to go off, and all we have is history, it hasn't predicted worse returns in the future. But we're talking about crypto anyway, right? So how does this apply to crypto? If 4% of stocks drive all the gains in the most established stock markets in the world, what does it mean for crypto? Crypto tokens are basically early stage startups. They raise money through tokens instead of equity. Yes, some other things are probably true as well. Some of them are commodities and blah, blah, blah. But what they actually are, when you really think about it, is they are tech startups that have used an innovative way to garner capital. Now, what does that tell you? Remember that stat from before, that the vast majority of gains in the US stock market were attributable to just 4% of companies. Now, that means 96% of companies did not do that. And they're companies with balance sheets, accountants, profitability, investment in procuring capital and using that capital to go and create better products. The best companies in the world, if you have a company and it makes it into the S&P 500, you are an incredible company. There's no doubt about it. And even in that case, you've got a 1 in 20 chance of really making it and providing returns to shareholders that are better than just buying short-term treasury bills. So how does that apply to crypto? Crypto is in its own niche sector. Brand new tech, startups. Both of those things, new sectors, tech and startups, have enormously high failure rates. So crypto obviously has an enormously high failure rate in terms of the products, the protocols, and the companies essentially that make it. If startup failure rate is 90% plus, and over 60% of all tokens that have ever been listed on CoinGecko are earmarked as dead already, the expectation that unicorns, or we're going to find the unicorn that makes it in crypto, is incredibly low, and actually even lower than it is when picking stocks. Picking stocks is already hard. And so for this sort of like thought experiment, I got rid of everything in crypto that isn't a token, right? So like stable coins, RWAs, figures, HELOCs, etc., and just compared what is Bitcoin's true dominance, because Bitcoin obviously is the number one, has been the number one the whole time. And it turns out that Bitcoin's real dominance in the market is about 70%. You can see like ETH makes up about 12.5% and XRP roughly 4%, Sol, Hype, etc., making up, 1%, Sol about 2%, etc. And so this means that in crypto, about 95% of all the value is held in the top 10 tokens. About 70% in Bitcoin and, another 25% for the rest of them all put together. And so now think about the things we just learned, right? Throughout all of history, the top 10 companies in the S&P are attributable to the vast majority, really, of gains of the entire index because the top 10 outperforms the entire index when you rebalance monthly. So what does this mean? It means that if you don't hold the larger things in crypto, praying that the things that you hold that are basically that have very bad charts, that have been down for a very long time, praying they come back and they are the one unicorn is not a good strategy at all. Traditional markets have told us that selling losers and holding winners is a much better strategy. I would bet most people, especially watching this, most people in crypto, do not have portfolios in crypto that are 70% market cap weighted to Bitcoin. But that's what the data says they should be. Now, maybe things are all going to be okay, but these bear markets, these periods of markets that go down, they're the best time to really think about how a portfolio needs to be positioned when it comes out of the bear market. Now, I'm not saying how you should position anything inside your own portfolio. I'm saying, look, this is the data inside the S&P 500 for the last 50 years. There's a few things to think about. Concentration risk is overstated. It hasn't been that big a problem in the past. Doesn't mean it can't be in the future, but the idea that just because things are concentrated in amongst the winners, that's a problem, isn't actually true when it's played out against the data. The other thing is that buying low often leads to ending up with lower in the future. Just because something has gone down doesn't mean it will necessarily go back up. The winners tend to win. The winners tend to compound over time and get better over time. This again is something that goes against traditional mindsets. There's some interesting data on buying the S&P 500 at the highs produces better returns than waiting for pullbacks, because that thing goes up all the time, basically ad infinitum. So guys, that is the data. Let me know what you think about whether your portfolio is aligned with what the data arguably suggests it should be. Of course, I'm not saying you should be doing necessarily anything. This is not financial advice. Crypto is incredibly risky, so risky. Like, most things fail. Most things fail. But if, like me, you think that this industry is going to be the infrastructure that the future of finance ends up running on, and there is value accrual into the things that dominate in that space, well, there's going to be some winners. It's hard to pick the winners. And hindsight in the traditional markets tells us, actually, you don't need to pick the winners early. You just need to hold a piece of all the winners when they become winners. Just need to give a quick shout out to today's sponsor, MetaMask. MetaMask are still exploring so many incredible new avenues right now. They're basically becoming, a neobank. If you don't know what neobank is, it's kind of all of what we want crypto to be in the future, where you just have everything in one place. You can trade, you can spend money, you can use prediction markets, you can use perpetuals markets, all that sort of stuff, right? MetaMask are basically building all of that inside one single application. Go check them out in the description below. Thank you so much to MetaMask for sponsoring the show. Thank you guys for watching. Honestly, massively appreciated. Leave a comment below. Tell me what you think about this thesis. Have I just completely lost the plot? The more I do these conversations with people, the more I kind of understand that maybe Bitcoin is the only thing we need to be holding. Anyway, I hope you have an excellent day, and I shall see you next time. Ciao, ciao.